Welcome to Leafless Lessons. You are watching the fourth part of our first series, The Wealth Blueprint. In the third part of this series, we covered Stop Investing Until You Have This, where we discussed the critical importance of an emergency fund. Now that you have your foundation secure and your cash flow managed, it is finally time to enter the growth phase. Today, we are talking about how to actually start investing and why mutual funds are the most effective vehicle for your journey toward financial freedom. The foundation of growth investing is not gambling, and it is not about getting rich overnight. It is the process of putting your money to work so that it earns more money over time. While your savings account protects your past, your investments build your future. The leafless truth is that if you only save your money, inflation will slowly eat your purchasing power. To build real wealth, you must own assets that grow faster than the cost of living. This video will strip away the complexity and show you the exact mechanics of how to begin. Understanding mutual funds. A mutual fund is essentially a pool of money collected from many investors to invest in securities like stocks, bonds, and other assets. Instead of you having to pick individual companies like Apple or Google, a professional fund manager or a set algorithm does it for you. This gives you instant diversification, which means you are not putting all your eggs in one basket. If one company in the fund performs poorly, the others can balance it out. This is the safest and most efficient way for a beginner to enter the market. The power of compounding. The greatest force in the financial universe is compounding, which is the ability of your earnings to generate their own earnings. Imagine you invest $100 and earn 10%. Next year, you aren't just earning 10% on your original 100. You are earning 10% on $110. Over 10, 20, or 30 years, this effect creates an exponential curve of wealth. The most important variable in this equation is not how much money you start with, but how much time you give it to grow. The case for index funds. There are two main types of mutual funds, which are active funds and passive index funds. An active fund has a manager trying to beat the market, while an index fund simply tracks a market index like the S&P 500 or the Nifty 50. Statistics show that over the long term, the vast majority of active managers fail to beat the index. Index funds are the leafless choice because they have lower fees and better long-term performance for the average investor. You are betting on the entire economy rather than a single person's opinion. Asset allocation and risk. Before you pick a fund, you must understand asset allocation, which is how you divide your money between equity and debt. Equity or stocks offers higher growth but higher risk, while debt or bonds offers lower growth with more stability. A simple rule of thumb is to subtract your age from 100 to find the percentage you should keep in equity. If you are 25 years old, you should have 75% in equity. This ensures you are taking enough risk while you are young to benefit from growth. The hidden killer expense ratios. Every mutual fund charges a fee called an expense ratio to cover its management costs. It might look small, like 1% versus 0.1%, but over 30 years, that difference can eat up nearly 1/3 of your total wealth. You must always look for funds with the lowest expense ratios. This is why direct plans are superior to regular plans. Direct plans allow you to invest directly with the fund house without paying commissions to a middleman or broker. SIP versus lump sum investing. A systematic investment plan, or SIP, is the process of investing a fixed amount of money every month, regardless of whether the market is up or down. This is superior to trying to time the market with a lump sum investment. When prices are low, your monthly SIP buys more units, and when prices are high, it buys fewer units. This is called rupee cost averaging, and it removes the emotional stress of investing. It turns wealth building into a consistent habit rather than a one-time event. The step-by-step execution. To start today, you need to complete your KYC, which is the Know Your Customer process required by financial regulators. You can do this entirely online using your identification documents. Once verified, you should select a broad-based index fund and set up an automated SIP that leaves your account the day after you get paid. By automating the process, you remove the temptation to spend that money and ensure that your wealth blueprint is being executed every single month without fail. Taxation and long-term thinking. You must understand that investing is a long-term commitment. Short-term fluctuations in the market are noise and should be ignored. In many regions, long-term capital gains are taxed at a lower rate than short-term gains, which rewards those who have the patience to stay invested for more than a year. Your goal is not to check your portfolio every day, but to keep your head down and stay consistent with your blueprint for at least 5 to 10 years. Conclusion and moving forward. Part 4 of the Wealth Blueprint is about taking action and letting time do the heavy lifting. You now understand that mutual funds and index funds are the tools that will build your bridge to freedom. Thank you for watching this installment of Leafless Lessons. In the final part of this series, we will discuss the mindset of a wealthy individual and how to stay disciplined when the world around you is panicking. Hit the subscribe button to complete the blueprint, and I will see you in the next lesson.